What if I told you that there was a very successful hedge fund manager who spent the last 20 years of his life building a billion-dollar fortune, but only to lose it all in only 2 days? Well, you might be thinking that this isn't possible because the rich diversify their assets. They're less aggressive in pursuing more wealth, and they especially don't bet big or their entire net worth on the stock market. Well, in this video, I want to profile the story of a trader who pretty much lost his entire net worth of $20 billion. Now, it's a sad story that you don't want to ever experience, but to learn from this trader's mistake. Hey traders, this is Mike Sir here. I've been an active trader for over 21 years and a trader coach for the past 15 years. In my videos, I profile all the top traders in the world and teach you how to replicate their incredible success. Now, I've been fortunate to train many successful traders, and in this video series, I'm going to talk about another successful hedge fund manager who made billions in the stock market. However, his story doesn't end well when he loses his entire fortune. His name is Bill Huang. Bill is a Korean-born American hedge fund manager who was one of the most successful amongst the Tiger Management alumni. Now, Tiger Management was the hedge fund powerhouse which developed numerous top traders who would end up running their own successful funds. In the 2000s, Bill ran his own hedge fund called Tiger Asia Management, which he grew with an initial seed capital of $25 million to at one point the fund having over $10 billion in assets. However, his trading success wouldn't last when in 2012, the Securities Exchange Commission, which is the SEC, charged him and his firm with insider trading of Chinese bank stocks. So what Bill did was he utilized confidential information that he received about a few China bank stocks and decided to short sell them and bet on these stocks going lower in price. The reason for the trades was his firm had bought private placement shares of these China bank stocks at a significant discount to the stock market's price at that time. He knew that the stock prices of these bank stocks would go lower once the private placement news was announced to the public. Then once the stock prices fell, he used his private placement shares to cover his short positions and exited the trades with a nice profit of over $16.7 million. Shortly after pleading guilty to insider trading and paying a fine of $44 million, he shut down Tiger Asia Management. However, it didn't take him long to get back into the industry, and he opened up a family office called Arch Eagles Capital Management to specifically manage his own money, which was about $200 million at that time. In less than 10 years, he turned his initial stake to over $20 billion. Bill was a stock trader and focused on trading promising public companies with strong fundamentals. At his Tiger Management Asia hedge fund, he specialized in trading the Asian internet and media stocks. But at his family office fund Arch Eagles, he focused on stocks in the US markets. The main reason is because he was banned from trading in his favorite market, which was the Hong Kong stock market. In addition, other Asian markets such as the Japan and Korea stock market, in which he specialized in, didn't offer much opportunities for him. Bill liked to build a highly concentrated portfolio of company stocks rather than be diversified like most hedge funds. His preference was to find promising opportunities in internet companies based in places like Silicon Valley and Chinese stocks listed in the US. He particularly liked technology companies who could disrupt the entire industry. One such example was his investment in Netflix. He and his team did extensive research on the company when it was just a DVD by mail rental service that was transitioning to video streaming. Now, Bill bet big on Netflix, having invested a huge chunk of his net worth in late 2012. As you can see here with the chart of Netflix, his investment paid off big time as he made close to $1 billion for his hedge fund. Another company Bill really liked was Amazon. You can see from this chart, he acquired shares in 2011 when the stock price was $186. Now he donated some of the shares in December of 2018 and sold some of them for around $1,478 per share. An incredible 700% return for him. Other companies that he liked were tech giants such as Expedia Group, LinkedIn, Google, and Facebook. And as you can see here, all these company stocks have done incredibly well over the past 5-10 years with triple-digit returns on these stocks. This outstanding performance of his concentrated stock portfolio led to his hedge fund averaging more than 100% returns on more than several occasions. However, in the past few years, his focus shifted to media companies such as Viacom CBS, Discovery, as well as Chinese stocks such as GSX, Tech EDU, Baidu, EQE, and VIP Shop. Like his previous tech holdings, he made heavy concentrated bets in his fund on all these names. Bill and his team had a knack for identifying huge winners and holding them in their highly concentrated stock portfolio. This was all due to their due diligence and research in trying to identify promising companies with massive potential. However, another reason for his hedge fund's incredible performance was the funds extracting as much leverage as possible, sometimes up to 5 times from a half a dozen Wall Street banks to buy his concentrated portfolio of stocks. This meant that if his fund had $20 billion in assets, then the fund could buy up to $100 billion in assets. How Bill and his team were able to leverage their bets were through total return swaps. Total return swaps are basically agreements between a bank and its client that are settled on the basis of changing prices in the underlying assets. Basically what this means is a prime broker would buy the shares on behalf of Arch Eagles and report itself as the beneficial owner when in reality Arch Eagles was bearing the financial risk. Basically what this is it gave Bill the upside associated with the stock investment without actually owning the securities. Now the benefit of doing this was it allowed big funds like Arch Eagles to build positions in the stock anonymously. As well, it allowed the fund to increase the size of its stock positions without having to put up too much of the funding required to buy them. So let me share with you how it works. So for example, a prime broker would buy the shares to execute a swap, and Arch Eagles would put up a percentage of the position's value in cash as margin. Now sometimes as low as 20%. Now the rest of the trade would be financed by the prime broker, and Arch Eagles would pay the borrowing costs. Now because swaps are settled daily with gains and losses netted out, Arch Eagles also had to post a second type of collateral known as variation margin if the value of its portfolio dropped. So basically the fund was on the hook for any losses due to stock price declines, but if it increased in value, the bank would pay Arch Eagles cash for its profits. Bill and his team's secret to incredible success was really quite simple. What they did was place enormous bets on a few concentrated high-flying company stocks and leverage it to the max. As prices go up, plow back every cent of the profit back into increasing the leverage bets. Now for a while, this strategy made Bill Huang one of the richest individuals in the world with a net worth of over $30 billion. March 22, 2021. Bill Huang will remember this day for a very, very long time. This was the start of one of the greatest wealth losses for a single individual ever. On that day, the company Viacom announced a $3 billion sale of stock and convertible debt. A big stock issuance usually adds more shares to the shareholder base and is usually bad news. This negative news caused the shares to plunge over 30% in a matter of 2 days. Now, this was very, very bad news for Bill's hedge fund, as it held a leveraged position of around $10 billion in this stock, and he was one of the largest shareholders in this stock. The huge loss in market value in Viacom stock pushed Arch Eagles over its margin limits. The prime brokers pleaded with Bill to reduce his positions in Viacom, but he refused to take some losses. However, by the close of trading on March 25th, Viacom stock was down another additional 5.3%. Now, to minimize their risk, some of the prime brokers who bought stock for Arch Eagles took action and started selling massive blocks of Viacom at a discount to hedge funds. In addition, they seized all the collateral in Arch Eagles swap accounts to minimize their risk. Once word got out about the massive selling spree, this caused further price declines in Viacom stock. Also, it didn't help that other Arch Eagles core stock holdings like GSX, RLX Technologies were also spiraling downwards as well, almost simultaneously with Viacom stock. By Monday, some of Arch Eagles' prime brokers, Goldman Sachs, Morgan Stanley, and Wells Fargo, those who acted early to offload Arch Eagles stock positions in the markets, they avoided any losses. However, those who were slow to react, like Credit Suisse and Nomura, lost close to $5 to $10 billion that were directly linked to Arch Eagles' collapse. So what mistakes did Bill make in his trading that led to the blow-up of his hedge fund? I've outlined a few mistakes here. Bill liked building a concentrated portfolio of stocks and didn't believe in diversification. In fact, he built massive positions in at least 9 stocks that were big enough to rank him among the largest shareholders in the company. Now, I understand Bill's thinking, because if you like a specific company a lot, then you want to own as much of a company that you can. But it's a very risky portfolio management strategy. Now, when your stock positions in the portfolio do well, you look like a genius and make a lot of money. But when many of your stock positions perform poorly, you could lose a significant chunk of your capital. This type of all-in strategy basically should only be used for capital that you can afford to lose, not for a $20 billion hedge fund. Bill's firm was able to place big stock wagers using swap derivatives, which allowed them to leverage their $20 billion stock portfolio to as much as $100 billion. In fact, they held very, very little cash, as everything was leveraged into their stock positions. Now, I get why Bill loved leverage, because I love leverage myself. Leverage allows you to buy more stock using the broker's money, and if the price goes up, you make even more money. But if the stock prices fell dramatically, you could lose your entire capital. So for a $20 billion hedge fund to as much as $100 billion and hold such a concentrated position, you risk becoming too big to react to a change in stock prices, especially when they dramatically fall. When Bill's Viacom positions plunged in value and triggered margin calls in his swap agreements, a few bankers pleaded with Bill to sell his shares. Now, it would be a big hit financially to Bill's net worth, but he could take those losses and survive. However, it wouldn't force the prime brokers to have to take action and fire sale his Viacom shares which led to even more selling of Viacom stock. But Bill refused to sell and limit his risks. The market was really telling him that his gig was up, but Bill refused to listen to the market. Ultimately, it was his ego that led to his downfall because he refused to be wrong. Thanks for watching. If you like this video, there are 3 things you can do. First is smash the like button for the YouTube algorithm, hit the subscribe button to watch more videos like this, and hit the notification button so you'll be notified of future videos where I profile the best traders. Second, if you're looking to learn how you can be the next top trader, please go to my website, MikeSir.com, to download my free ebook, Become the Next Millionaire, where I profile a few of my millionaire students. Lastly, if you're looking for a mentor and want to learn directly from me, please go to MikeSir.com to apply to work with me.